Hello number curious friends, welcome to the channel where we talk accounting and finance. Today we continue with the current assets and move down the balance sheet to accounts receivable, also called trade receivables. You will learn when to recognize them, how to measure them, how to handle returns and bad debts, and how to read simple KPIs like days of sales outstanding. As always, we will use our Apple shop and a few clean journal entries. Accounts receivable appear when you sell goods or provide a service, but the customer doesn't pay at once as you agreed to wait for a payment. You offered your customer a credit period. It can be 10 days or 30 days or 60 or even longer. In general, typical credit periods for receivables deviate between 30 and 60 days. This is your asset, your claim towards a customer. And on the balance sheet they are normally right below inventory. You can find the basics about receivables in our earlier videos. The link is in the upper right corner. So, you recognize the receivable when you recognize revenue. That is when control of the goods or services passes to the customer. Now, let's get back to our Apple shop. For a simple sale on credit of apples for $1,000, the journal entries will be: debit accounts receivable $1,000, credit sales revenue $1,000. And now let's complicate it a bit. We love challenges, don't we? The majority of sales within the same country are done with value-added tax, or VAT, something similar to sales tax in the US. If VAT is 20%, your total sales price will now be $1,200. And here starts the complication. The sales that you record in the income statement are always without VAT, and costs also. All P&L is always without VAT. VAT runs through balance sheet and cash flow only. So, how do you reflect that in accounting? The journal entry for the sale with VAT would be: debit accounts receivable $1,200, credit sales revenue $1,000, credit VAT payable $200. The receivable is the full amount, as you do expect $1,200 from your customer, but then $1,000 belongs to you and $200 you need to pay to the government. So you record a liability for that. 2 credit entries which add up to $1,200. And in the T accounts world it will look like this. And before we move on, if you find our lessons useful, please take a moment to hit the like button and subscribe to our channel. And thank you for being with us, this is very important for us. When the customer pays, you reduce the receivables. Let's imagine the customer settled the full amount. The journal entry will be: debit cash $1,000, credit accounts receivable $1,000. And again briefly, T accounts. But what if you don't want to wait for 30 days and would like to get your cash earlier? One of the incentives you could use is an early payment discount. You email your customer and tell them that if they pay within 10 days, you will give them a 3% discount. A customer thinks, why not, and pays you earlier. A discount ultimately reduces your revenue and is reported separately in the P&L. The journal entries here would be: debit cash $970, debit sales discounts $30. Debit to P&L means an expense, remember? Credit accounts receivable $1,000. What is another scenario that can happen to our Apple sales? Let's imagine the apples we have sold got completely bruised during transportation and the customer refused to accept them. As we will never receive our payment now and the sales as such should be cancelled, we post the following journal entry: debit sales returns and allowances $1,000, credit accounts receivable $1,000. In another scenario, only half of apples got bruised and only slightly. We think we can resell them later. Then we reverse half of the sale and put the returned apples back into inventory. Let's assume we were selling at a profit of 50%, meaning for each dollar of sales we had a cost of 50 cents. So returning $500 of apples will mean their cost was $250. That's exactly the amount we put back into inventory, and journal entries will be: debit sales returns and allowances $500, credit accounts receivable $500, debit inventory $250, we put apples back, credit cost of goods sold $250. We need to also cancel COGS. The sale didn't happen, but we also didn't lose our apples. And yet another scenario. The customer doesn't return the apples but requests a discount of $100. When you give it, you decrease your receivables for that. Debit sales discounts 100 goes to P&L, credit accounts receivable 100. So, a trade receivable is an amount a customer owes you for goods or services you already delivered, and it is a current asset if you expect to collect it within a year. But not all customers pay. Here and there you will have the customers who run out of money, disappear, or simply ignore your requests to pay. Accounting principles typically require you to recognize a so-called allowance for doubtful accounts receivable for expected credit losses. On the balance sheet, you show trade receivables gross, less allowance for doubtful accounts, which gives trade receivables net. This allowance can be calculated using different ways. The most common approach is based on the lifetime experience and aging metrics. For example, you know that if the customer doesn't pay for more than 360 days, then the chances he will pay are close to zero. So you record allowance of 100% for those receivables. For the customers who don't pay for more than 180 days but less than 360 days, you estimate the risk at 50% and record the allowance for that, and so on. The journal entries would be: debit allowance for doubtful accounts 50 goes to P&L as a loss. Credit allowance for doubtful accounts 50 reduces your accounts receivable on the balance sheet. It may also happen that a specific customer goes bankrupt and you identify that directly. Then you specifically record that as a bad debt expense and remove receivables from that customer. Debit bad debt expense 30 goes to P&L, credit accounts receivable 30. If that customer was already in your allowance, for example, didn't pay for more than 360 days, then you remove it from the allowance and from receivables. Debit allowance for doubtful accounts 30, but this time on the balance sheet, no P&L impact. Expense was recorded when the allowance was recorded initially. And credit accounts receivable 30. If the customer then suddenly pays, you will record income from recovery of bad debts. Debit cash 30, credit bad debt recovery 30, income in the P&L. And another complication. Let's have some more fun. Receivables in foreign currency. If you invoice in a foreign currency, you need to record the receivable at the spot rate on the invoice date. Spot rates mean the rate on the same date as invoice. For example, you send an invoice in euro for 1000 euros. On the day of the sale, the exchange rate to US dollar is 1.15. That means $1,150, and you record the following: debit accounts receivable USD 1,150, credit sales revenue 1,150. What happens when in the end of the year the customer has not paid yet, but exchange rate is now 1.20? If the customer paid you now, you would have more money in USD in your bank account. We need to reflect that in our books. Your receivable will now be $1,200, an increase of 50. This increase is called an FX gain, or Forex gain. FX stands for Forex or foreign exchange. And of course, it can be a loss too. Now the journal entries for this. Debit accounts receivable 50 to increase expected payment, credit Forex gain 50 in the P&L. If we received money now, we would have higher profits in USD. For now, our gain is unrealized. We have not received cash. If tomorrow the exchange rate drops, we will need to record Forex losses, also unrealized. And when the customer pays, it becomes realized. What are the KPIs which we use for accounts receivable? The first one is the mentioned aging schedule. It groups receivables by days outstanding. It helps you set allowance and target collections and can look like this. Columns with the following categories: not due, overdue 1 to 30 days, overdue 31 to 60 days, 61 to 90 days, overdue 91 to 180 days, overdue 181 360 days, and overdue for more than 360 days. In the rows we will have the list of the customers, for example like this. And then we will have a summary for all customers and all buckets. And yes, the same customer can end up in different buckets at the same time, depending on individual invoices. Another important KPI is Days Sales Outstanding, or DSO. Remember, we discussed DIO for inventory? Exactly the same concept. It is calculated as trade receivables divided by annual sales and multiplied by 365. Alternatively, you can divide receivables by monthly sales and multiply by 30 or 31. And note, you better use only credit sales, and not all invoices if you also have cash sales. For example, for supermarkets, it doesn't make sense to use sales which go through cashiers and apply them to the accounts receivable from your big corporate clients to whom you sell on credit. And another note, as trade receivables are with VAT and sales are without VAT, ideally you would remove VAT from receivables or add back VAT to sales, ideally. But shortcuts are acceptable as long as it is consistent and VAT does not distort numbers a lot. Let's have a look at an example. Last year we sold apples and apple jam for $20,000. In the end of the year we had $2,000 in receivables. Our DSO were 2,000 divided by 20,000 times 365 equals approximately 37 days. So, last year it took us approximately 37 days to collect receivables. This year we grew our business and had sales of 30,000, receivables were 2,500. Our DSO are 2,500 divided by 30,000 times 365 equals 30 days. Looks like we have improved our collection. Well done! Now let's summarize the lesson. Receivables start when you recognize revenue. Collect cash and post discounts properly. Record returns and credit notes and record them on time. Measure receivables at billed amount minus an allowance for expected losses. Write off specific bad debts against the allowance or against specific receivables. Use an agent schedule and DSO to monitor the receivables. That is trade receivables in plain language. In the next lesson we will cover factoring and examples of internal credit controls. If you have other questions to receivables, post them in the comments below and we will try to cover them in the next video. Thank you for watching. If you enjoyed this lesson, hit like, subscribe and ring the bell so that you don't miss the next lesson. See you soon and keep those debits equal to your credits.